Why are stock prices failing? Is it the 2025 presidential election, global unrest, or something else entirely? Uncertainty is gripping the markets, and investors are nervous. According to MarketWatch, 6 of the 7 conditions for a market bubble are present, including speculative retail investment and pressure on corporate earnings. Meanwhile, the new era of U.S. politics under President Donald Trump is shaping growth prospects and amplifying fears of trade wars and geopolitical conflicts. In this video, we'll explore the key reasons behind the recent market declines and the factors shaping today's financial and political landscape. If you've been wondering how these events affect your investments, stay with us until the end. 5. Global geopolitical tensions. Geopolitical tensions are among the most significant factors driving market instability in 2025. Conflicts in Eastern Europe, particularly the ongoing war in Ukraine, have disrupted energy supplies and trade routes. The reliance of Europe on Russian gas has diminished due to sanctions and embargoes, but alternative energy solutions remain insufficient to stabilize costs. This has led to spikes in energy prices, reducing disposable income for consumers and straining corporate budgets. In East Asia, the contentious relations between China and Taiwan are heightening fears of a military conflict. Any escalation in this region could disrupt global supply chains, particularly in the semiconductor industry, which is vital for everything from smartphones to cars. According to Cinco Dias, such tensions not only shake investor confidence but also trigger immediate economic ripple effects worldwide. The US-China rivalry is another cornerstone of geopolitical instability. Trade wars, coupled with increased tariffs and sanctions, are forcing companies to rethink their production strategies. Relocating manufacturing hubs or diversifying suppliers requires significant investment, further eating into corporate profits. Investors are watching these developments closely as the long-term impact on global trade dynamics remain unclear. Supply chain disruptions are particularly worrying for industries dependent on just-in-time manufacturing. Delays in shipping and production not only increase costs, but also reduces revenue predictability, adding to market volatility. The unpredictability of global diplomacy combined with these economic impacts amplifies investor anxiety and exacerbates market fluctuations. Finally, governments worldwide face pressure to navigate these challenges effectively. However, the lack of cohesive international strategies and frequent policy shifts leave markets guessing, ensuring that geopolitical tensions remain a top driver of stock price declines in 2025. 4. Rising interest rates. Central banks' aggressive rate hikes to combat inflation are sending shockwaves through the global economy. In the US, the Federal Reserve has maintained a hawkish stance, with consecutive rates increased aimed at controlling runaway price levels. While inflation has shown signs of moderation, the higher borrowing costs are choking economic growth and weighing heavily on markets. One of the most visible impacts of rising interest rates is on corporate investment. With loans and credit becoming more expensive, businesses are scaling back expansion plans. Sectors like real estate and construction are particularly hard hit as mortgage rates soar and property demand dwindles. For tech companies reliant on venture capital and debt funding, the costlier borrowing environment is forcing layoffs and operational cutbacks. Consumer spending, a key driver of economic activity, has also taken a hit. Higher interest rates means costlier loans for individuals, from mortgages to credit cards. As disposable income shrinks, consumers are cutting back on discretionary spending, further reducing corporate revenues. Retailers and service providers are among the most affected, facing both reduced demand and higher operating costs. Another consequence is the shift in investor preferences. Rising interest rates makes bonds and other fixed income instruments more attractive compared to equities. This reallocation of capital leads to reduced liquidity in stock markets, driving down prices. For risk-averse investors, the allure of guaranteed returns in bonds outweighs the uncertainty of stock market gains. Looking ahead, uncertainty looms over how long central banks will maintain this tight monetary policy. Investors are bracing for prolonged economic pain, with some fearing that overcorrection could push economies into recession. This cautious sentiment continues to weigh on market performance, exacerbating declines. Don't miss out on crucial updates about the markets. Hit that subscribe button and stay informed. Free. Weak corporate earnings. Corporate earnings, a cornerstone of stock market valuations, have been disappointing across multiple sectors. Companies are grappling with the twin challenges of rising costs and slowing revenue growth, leading to profit margins being squeezed. The tech industry, once a growth engine for markets, is now under pressure. Supply chain disruptions, high inflation, and reduced consumer demand for gadgets have led to sharp declines in earnings. Companies like Apple and Amazon have revised their growth forecasts downward, signaling tough times ahead. Meanwhile, startups and smaller firms, which are more vulnerable to economic slowdowns, are struggling to secure funding. Rising labor costs have further compounded these issues. Inflationary pressures have led workers to demand higher wages, increasing operational expenses for businesses. For labor-intensive sectors like manufacturing and retail, these higher costs significantly impact profitability. Forward guidance from companies has been another red flag. Many CEOs have expressed caution about the economic outlook, citing persistent inflation, geopolitical risks, and reduced consumer spending as key concerns. This lack of optimism only fuels investor skepticism, leading to stock sell-offs. The retail sector exemplifies the broader trend. Companies reliant on discretionary spending have reported reduced foot traffic and lower sales volumes. As consumer confidence wanes, the ripple effects extend across supply chains, dampening economic activity and market sentiment. 2. Market trends and overvaluations. Stock market overvaluations, particularly in the tech sector, have been a ticking time bomb. During the pandemic-era bull market, many companies saw their valuations skyrocket due to optimism about future growth. However, as economic realities set in, these inflated valuations are undergoing painful corrections. The transition from growth to value stocks is reshaping market dynamics. Investors are now prioritizing companies with strong cash flows and stable dividends over speculative, high-growth ventures. This shift has led to sharp declines in sectors like fintech and electric vehicles, which were darlings of the previous bull run. Algorithmic trading has also played a role in amplifying market volatility. Automated systems, programmed to react to price changes and news, often trigger large sell-offs when certain thresholds are reached. This mechanized trading creates a snowball effect, where initial declines lead to further selling pressure. Another factor contributing to market trends is the rise of retail investors. Platforms like Robinhood have made stock trading accessible to millions, but this democratization has also introduced speculative behaviors. The surge in meme stocks and social media-driven trades adds unpredictability to market movements, deterring institutional investors. Finally, sectoral imbalances remain a concern. While some industries like energy and healthcare are thriving, others face headwinds. This uneven performance underscores the challenges of navigating a market in transition where traditional rules no longer apply. 1. 2025 Presidential Election Uncertainty. The upcoming U.S. presidential election is arguably the most significant factor influencing markets today. Historically, election years bring volatility, but a 2025 race is particularly contentious. The stakes are high, with debates over taxation, trade policies, and healthcare reforms dominating the political discourse. Healthcare, energy, and technology are among the industries most exposed to potential policy shifts. For instance, a change in administration could bring stricter regulations on tech giants or increase subsidies for renewable energy. Such policy uncertainty keeps investors on edge, as the outcomes could significantly alter market dynamics. Election security and the possibility of delayed results add another layer of complexity. With increasing polarization and concerns about electoral integrity, investors are preparing for extended periods of uncertainty. Markets thrive on predictability, and the lack of clarity surrounding election outcomes exacerbates volatility. Campaign rhetoric also plays a role. Proposals for wealth taxes or increased corporate taxation are scrutinized by investors, as they could directly impact corporate earnings and investment incentives. Conversely, promises of deregulation and tax cuts may provide temporary boosts to certain sectors. As the election approaches, expected heightened market sensitivity sensitivity to poll results and policy announcements. While the uncertainty is unsettling, it's worth noting that periods of volatility often create opportunities for savvy investors willing to take calculated risks. Here's the truth. Market downturns are inevitable, but they're also opportunities. I'll give you 5 tips. 1. Diversify across sectors. Spread your investments across industries to minimize risk from sector-specific downturns. 2. Focus on value stocks. Invest in companies with strong fundamentals and consistent cash flow to ensure stability. 3. Embrace dividend stocks. Look for firms with reliable dividend payouts for steady income even in turbulent times. 4. Monitor global trends. Stay informed about geopolitical events and policy changes that can influence markets. 5. Practice patience. Avoid emotional decisions during volatility. Stick to your long-term strategy. Market downturns may be unsettling, but understanding the reasons behind them is the first step to making informed decisions. Subscribe now and stay ahead with insights to navigate uncertainty.